Hello, welcome. This is Craig Pritz from JRG Advisors. First, real quick housekeeping before we get started on our webinar today. If you have questions, please use the question box in the upper right-hand corner. We are going to be answering all the questions at the end. We will be sharing a copy of today's presentation, as well as the question and answers. I really want to start by thanking our valued clients who are with us today and our growing number of partners. Thank you so much for joining us. A little bit of the agenda today. Today we're going to talk about health insurance benefit renewal strategies. A lot of groups are going to be renewing here in the upcoming months, and we want to talk about some of the strategies that they should be looking at. First, we're going to talk about cost containment and why it's necessary. We're going to talk about consumer-driven health plans, defined contribution models, private exchanges, voluntary benefits, both self and level funded premium plans, employee risk measurement tools, and we're going to end strong with some talk about compliance today. First, though, why is cost containment necessary? You know, we've been talking about the Affordable Care Act now for a couple years. Most groups are living in the Affordable Care Act world, but one thing that's really missing today is the affordable part of it. And the truth is companies are still seeing their premiums continue to rise year after year. And the only difference is now our employers have to deal with the Affordable Care Act requirements and the renewals at the same time. And this is creating a lot of strain on employers. The truth is solutions are needed. Today we're going to talk about some employer-geared solutions, and we're going to talk about solutions that are based on companies of different size, geography, employee needs. The truth is, not all of these solutions are the best for every single company out there, but every company out there needs to be aware of these options. They need to know what's out there so that they can be finding the best solution for their company. So let's talk about consumer-driven health plans first. Consumer-driven health plans, really we're talking about qualified high-deductible health plans. A lot of surveys or a lot of studies recently will show that this is probably one of the most common cost containment strategies, meaning that this is one of the models that employers use more frequently. Qualified high-deductible plans. These are plans that have been qualified and approved by the IRS. They meet a certain list of IRS guidelines, things like minimal deductible. They have requirements as far as when co-pays start before or after the deductible. So there's a lot of guidelines that these plans have to meet. But when a plan meets these guidelines, it is considered qualified. Health insurance companies will use the word qualified in the title or maybe the letter Q to identify these types of plans. But these plans are able to be set up with a health savings account. And a health savings account is a separate account that is owned by the employee. It is an account that allows the employee to put money aside on a pre-tax basis. The account can also be funded by any third-party person as well, including the employer. The employee gets the pre-tax advantage, though. Those accounts, that money grows, it earns interest. Very importantly, that money rolls over year after year if it's unused. So this is not a use it or lose it scenario. And that money is there for the employee to use for their out-of-pocket expenses. This is a real big step for employees when an employer goes to this model coming from a low or zero deductible. This is a pretty big change for employees. And one of the reasons is these plans are designed that the deductible must be satisfied first before the insurance kicks in, meaning the employee has more upfront responsibilities. A lot of times when employers are making moves to these plans, they will contribute something to the employee's HSA to get it started. That's a common way for an employer to make a shift to a qualified high-deductible health plan. But in the end, these are one of the strategies that we see employers using today. These can also be included on what we like to call a defined contribution model, and that's the next thing I really want to talk about. You know, the most common strategy today is probably the move to a qualified high-deductible plan, but the strategy that's probably growing the fastest is the defined contribution model. A defined contribution model, what it is, it's a model that allows an employer to determine how much they want to contribute for the employee's benefits. A lot of times we'll sit down with employers and help them realize this based on things like what they were contributing previously, what their budget can afford. The nice thing about this model also is it allows employers to really budget for future years. It gives them a strategy going forward. A lot of employers will determine in year one what they want to contribute the second year, what type of increase they want to apply to it. The benefit of a defined contribution model that really comes to the employees in the sense that the employees are given more choice. You know, in today's world, an employer spends 30 days or more trying to find the best plan for the business and the best plan for the employees. The truth is those are very different things. And when the employee is given choice, more times than not, that employee is going to choose a different plan. They know the needs of their family. They know how they want to spend their health insurance dollars. So the plans allow employers to control their costs. They provide more choice and flexibility for the employees. But a lot of times we'll see these include what we call more robust benefit packages. We'll see employers adding additional benefits to these. It's not uncommon to see these packages, defined contribution models, include more than just medical, dental, and vision. A private exchange is really the vehicle that the defined contribution model can be delivered on. A private exchange, think of it like a website. You know, private exchanges were kind of designed to be like an Amazon type shopping experience. But the private exchange can be set up to convey to the employees the amount of contribution from the employer and show the plans in a menu format to the employees that they have to choose from. Defined contribution models, they're designed that they have some flexibility as far as the number of plans that can be offered. You know, 2, 3, 4, maybe 5 plans. Typically you don't want to offer too many choices. But with a private exchange, it allows you to show those plans really in a side-by-side comparison for the employees. And a lot of times the private exchanges will include a lot of additional benefits. It's not uncommon to see these private exchanges built to include things like long and short-term disability or life insurance or the spending accounts like a health savings account through there. So they offer a variety of different insurance products. And there's a lot of different types of private exchanges out there today. There's very basic exchanges that will convey the dollar amount, display the plans, and help the employee make their selection. There's also very, very detailed and intuitive exchanges out there, models that can help employees pick their plan based on their tolerance for risk, based on their savings that they might have, liquid assets that they might have. It can help employees pick plans based on current medications or known doctor's visits that they have. So that there's some pretty impressive forms of private exchanges out there. One of the very exciting things about private exchanges is where they're going. You know, things like onboarding, enrollment for your new hires through the private exchange, billing. We're going to talk about compliance, and one of the things with compliance is there's a lot of reporting today. There's private exchanges that can do the reporting as well. And there's new private exchanges. These are really being developed all the time. It seems like every time we turn around, we're hearing about concepts for new ones. I can tell you a little selfish plug. JRG has a fantastic private exchange coming out here in the very near future that will include all of these things and more. But the truth is, no matter where you look online, you're going to find out that defined contribution models and private exchanges, the numbers are increasing. I've seen different numbers everywhere, but the bottom line is the number of people using these plans is going up every day. These are the wave of the future. And this type of model really wasn't available in the past for smaller employers. A group as small as 2 employees can really have a defined contribution model in today's world. Some with or without the private exchange aspect of it, but it's really available for all size companies today. Next, we want to get into voluntary benefits, and the reason it was important to talk about this next, a lot of times you will find voluntary benefits on a private exchange. When we say voluntary benefits, what we're referring to is these are the benefits employers like. These are the non-employer paid benefits. These are things like accident policies, life policies, long and short-term disability, cancer policies. These are the types of plans that employees want. Studies show, when asked, employees want access to these benefits. and they're willing to pay for them using their own money. These really make sense. Every employer should offer voluntary benefits to their employees. And there's a lot of reasons today. Number one, I mentioned that employees want these benefits, but the reason they want them and the reason that they make sense. Think about where your health insurance plans have gone over the years, and think about where your deductibles and co-pays have gone. They've been increasing. It's the nature of the industry right now. But also the plans that are out there today have more out-of-pocket cost. So we're seeing plans with higher deductibles and more out-of-pocket. These type of voluntary benefits for a very low cost monthly can fill those gaps for employees. Next, we want to do a little bit of a short dive into self-funded and level-funded. We've done entire webinars on this concept, and this is really something that's a newer concept for smaller businesses, but it's not uncommon for larger businesses to use a self-funded or a level-funded strategy. These models are available today actually down for groups with as few as 10 employees enrolled. You're probably going to see more success in the 20, 25 range or higher. But the truth is, if you're a company as few as 10 employees, you should know about this. You should be talking about it. You should have the conversation. Maybe it's not the best fit right now, but it may be in the future. So models do exist for companies down to 10 employees. And for companies that have not been on a self-funded plan, just to give you an idea how many people actually are self-funded out there. In 2014, approximately 61% of all the covered workers in the U.S. were in a self-funded plan. That's a lot. So how does self-funded work today? What does this all mean? I'm going to take us back in time a little bit. 1974, when ERISA was passed, ERISA preempted self-funded plans from being controlled by the state. And really what that means is your fully insured plans that you buy from the insurance companies today include fees and taxes that are required or mandated to be there by the state. Self-funded plans are exempt from those. So self-funded plans have a built-in savings in that they are exempt from some of the state and federal fees and taxes that are required. But how they really work and how this is not a real scary concept for a small business today. Businesses will determine what we refer to as kind of a pulling point. This is their threshold for where they're willing to pay claims. They will also purchase on top of that third-party administrator services from an insurance company, a third-party administrator, Highmark, UPMC. A lot of the insurance companies offer this service. And what they will do is the insurance companies will rent you their network. They'll manage the claims. They'll process them for you. And they'll do that for a fee. There's a lot of levels of services that you can purchase, and there's a lot of areas for different size businesses to look and determine what needs they need from a third-party administrator and determine what they want to spend for those. Sometimes a broker can help with some of those as well. But you determine your pulling point, what your threshold is. You find a third-party administrator and you pay them a fee to administer the plan. And then this is where the fear goes away. On top of that, you purchase stop-loss insurance. And there's a couple different types of stop-loss insurance. But essentially what you're doing is purchasing protection against the big claims, the things that keep the business owner awake at night. If those three costs combined are comparable to what you're looking at a fully insured price, it makes sense to have the further conversation. There's a lot more details that go into this, and I don't want to take the whole time talking about self-funded, but I do want to just talk a little bit about level-funded, because this is a different type of self-funded that's out there today. And this really can make sense for the groups that are newer to self-funded. If you've never gone that way before and you're a little worried about the risk, level-funded comes with a little bit higher premium, but it eliminates a little bit of the risk. This is something we can talk about in more detail and talk about for a very long time. I don't want to take too much time talking about today, but I think that every company needs to be aware that self-funded is now an option out there. It gives you control of your data. It helps you plan for the future better as a business owner, knowing what the makeup of your group is like. It helps you make changes that can impact your cost. And when a self-funded plan is put together in this manner, it can really make sense for a group. So again, everybody should be aware of this as an option. Next, we want to talk about what we're calling employee risk measurement tools. Really, this is Wellness 2.0. This isn't last year's wellness or 2 years ago wellness plans, but these are new and enhanced approaches to measuring risk. And let's be very, very honest. In the Affordable Care Act world, a wellness plan probably does not have the direct impact for a small business that it would have had prior to the Affordable Care Act as far as the rate goes. But this can very much make sense, both fully insured and self-insured, both for small groups still under 100 in the ACA world and groups over 100. And here's how. Number one, when you set up a tool like this, what we're referring to as employee risk measurement tools, you're getting the data that helps you structure your benefit plans for future years. You have access to data that you were never given before. As a group under 100, you can ask the insurance companies all day long for your claims history. They'll never give it to you. But this is going to give you concrete data that's going to allow you to better structure your plans going forward. And when a employee risk measurement tool is partnered with a self-funded plan, it makes a lot of sense. And then you do see a return on your investment more so than you would outside of a self-funded plan. So the business gets a lot of data, but really the employees do too. They get access to health coaches that are able to help them make informed decisions, help them change lifestyles. This next point is the reason that every group should be looking at employee risk measurement tools. Nearly 75% of all healthcare costs are preventable. That is just an amazing number if you think about what you put out the door for your premiums and you think about cutting that, take 75% off of that and what that number would look like. So the fact that 75% of all healthcare costs are preventable, that's why groups should be looking at employee risk measurement tools. And we've got some fantastic ones out there that we can help you with. So those are some really good strategies for controlling costs. Again, not every one is the best fit for every company, but every company should be aware of every one of these and talking about these. Now, just when you thought you got your renewal complete, you took a big, deep breath, let's talk compliance. The unfortunate fact is that the Department of Labor is conducting audits. It's happening already. It's going to happen for everybody as far as they say. They've hired thousands of new agents to help with these audits, and they're looking for certain things. Really, they're looking to make sure that businesses are adhering to the Affordable Care Act. The truth is, for this thing to work, we need everybody involved. But they also felt that while they're out there, it would be a good idea to look at the summary plan description that was part of ERISA in 1974. So the audits are coming, and they're looking for a couple of things. They're looking for groups to provide a summary plan description. This is probably one of the confusing parts of compliance, because a lot of people look at me and say, well, yeah, we gave that to our employees. That's our plan grid. Or doesn't the insurance company give that to us? The truth is no. A summary plan description, this is really something that your benefits attorney is expected to prepare for you. And this is a document that is made up of contract language from all of the benefits that you offer on a group basis. It includes information on Women and Newborns Health Protection Act, Women's Cancer Right Notices, CHIP, HIPAA. There's a lot of information that goes into this master document. And the truth is, if you ever go and Google like Department of Labor audits, you'll find that the summary plan description is really the go-to document if there's a discrepancy when it comes to your benefits. It's the first thing a judge will ask you to show, and it's one of the first things they ask you to provide in an audit. So these are things that businesses need to be aware of, and when the Department of Labor sends out the letter, they need to be able to provide these. 2014, almost 65, I think it was 64.7% of all the audits resulted in either corrective action or monetary fines. The fines are very hefty. The fines started at $110 per employee per day for certain aspects, $1,100 for other aspects of the fine. So there's some very big fines involved here, and the truth is this money is going to be used to fund healthcare reform. That's what this money is going to be used for. So these audits are happening. Again, I know that a lot of people ask me, well, doesn't the insurance company provide this? And the answer, again, is no. You're really expected to go out to your benefits attorney. Another quick shameless plug for JRG, we do have the ability to help with this document, and we can do it at a fraction of the cost of what a benefits attorney would do this for. So it is something that, unfortunately, it's keeping business owners up at night, but it is something that we can help with. It should be keeping you up at night unless you are protected. So I encourage everybody to make sure that they are in compliance, not only with the summary plan description, but the reporting aspects of the Affordable Care Act as well. Wow, we're going to kind of wrap it up there. Take a look and see if we have any questions to address. Again, while we're pulling those questions together, I want to mention that we will be providing a copy of this webinar, as well as all the slide shots and the question and answers.
Okay, the first question. What insurance carriers in the Pittsburgh market provide plans to small businesses with less than 20 employees and cover UPMC providers?
Great question. Network is probably the top thing that we discuss with businesses when talking about benefits, renewals, and a lot of that has to do with Highmark and UPMC. In today's world, you have a couple insurance companies in the area that have access to all the hospital systems in Western Pennsylvania. United Healthcare, Aetna, Health America have access to both the UPMC-owned hospitals, the independent hospitals, and the Allegheny Health Network hospitals. When it comes to UPMC and Highmark specifically, they do not have access to some of the hospitals. Highmark does not give you access to 6 UPMC hospitals, 7 with Community Blue, and there are some outlying hospitals that come at some higher rates. UPMC does not have access to a couple hospitals in the Allegheny Health Network. Those are specifically related to small businesses. I mentioned the insurance companies that work with small businesses. When it comes to individuals and larger companies, there are a little bit different answers. There are different players there. You have Cigna available to very large companies as well.
Okay, the next question. For employers going to the defined contribution and private exchange, do most, oh, I'm sorry, give me one moment, the screen just flickered. Do most give employees a flat amount or more for employees with dependents?
That is a great question, and I'm going to back this up one step further. When it comes to the contribution, it is important that you talk to your benefits advisor. There are discriminatory and non-discriminatory ways to come up with contributions. But as far as what you're asking, as far as what we're seeing out there today, the truth is there's been a big shift in what's happening, and my guess is you're asking because there may be a shift coming at your business as well, or maybe recently there was. In the past, businesses paid as much as they could for the entire families when they could. But the truth is rising costs have caused a lot of businesses to reapproach that. And some of the avenues that we're seeing today, we are seeing businesses that define a contribution solely for the employee and let the employee decide if they're going to pay more to cover their spouse or dependents. Keep in mind, you have the choice of whether or not you provide coverage for a spouse. You can make that decision across the board. You do not have the choice of whether you cover dependents or not. You have the choice of how much you charge, whether you make the employee pay, but you cannot deny your employees the ability to cover their dependents. So we're seeing this shift in what employers are doing. We're seeing some employers today that are defining a contribution, like I said, that is based solely on the employee. But I think when an employer can, they want to provide a contribution for the entire family if they can. You know, and you think about your situations out there, everybody on the line is probably in the position where they want to provide as much as they possibly can. The struggle is what the business can afford. And that's the shift that we're seeing in these days.
The next question. Are summary plan descriptions required for employers with under 50 employees?
Great question. I apologize for not saying this. Yes, the truth is a summary plan description is required for all businesses that are considered ERISA compliant, which could, under some very unique circumstances, be a business all the way down to 1 employee. The truth is if you have 2 or more employees and you offer group benefits, we need to talk.
The next question, This person is making a statement that they have a 15-person company and they don't have a benefits attorney.
And you are not alone. I think the biggest reason that JRG advisors searched so hard to find an avenue for the compliance was because we recognized that a lot of most of our clients, including us, are like you. We don't have that super team of attorneys. We don't have the Johnny Cochran's on retainer like most businesses don't. And the truth is, when we went out to find out what attorneys would charge for that, we were hearing things like $1,250, $2,000, $2,500 a year for that document. We know businesses can't afford that. And I tell you, we can do that for you at a fraction of the cost. And the main reason we went out, I think, to find this software was because we recognized that you're not alone. Most businesses are like you. Thank you.
The next question, how often does the summary plan description have to be redone? Is it every time the plan changes?
That is also a great question. God, I think we've got employees asking these, throwing me softballs today. Very, very, very good question. The truth is we're going to update that for you every single year. But there are strict guidelines. If there's never a change made to your benefits, you still have to put it in your employees' hands every 10 years. There's times when you have to put it in their hands every 5 years. Every year, your benefits are going to change in some way. They go up, the premium changes. We're going to update that form for you every single year at a very, 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 very low cost. We'll get into the cost specifically as far as it goes for groups out there, but we will create the summary plan description at a huge fraction of what anybody else would charge, and then year after year we update that for really pennies, for next to nothing for you.
The next question, what about other ACA reporting such as section 6055 and 6056?
A lot of reporting out there. There's a lot of things that businesses have to be doing. There's reporting based on the number of employees you have, and the truth is we have a lot of different size groups on here today, and this applies to different size groups. What we'll do is when I put the answers out, when we distribute them, I'll give you a little bit of a breakdown. We'll attach a little something there that gives you some more information on that, on the reporting. But you need to be talking to your broker, your advisor. Every group has some reporting requirements. They do change a little bit based on group size.
The next question, can you provide an example of how a claim would be processed if there was an HSA involved to better explain to an employee how this would work?
Yes. This is a great question. There's a couple different ways that this works. So when an employee sets up a health savings account, they're doing that with either the financial institution that the health insurance partners with, or maybe one that the employer chose to work with that is a third-party administrator. Every company is a little different. They all provide different ways of going about this, but for the most part, they're all going to give you a debit card or the option to have a checkbook or the option to do a direct transfer. And so let me run through a scenario for you. You go see your doctor, and you have an HSA set up, and your doctor's visit costs $60, and you have $60 in your HSA, and you have an HSA debit card. You can give them that debit card right at the point of service. Let's say you have an HSA, and you have only $20 or $30 in there, and you don't want to pay them at that time. What you can do is you can pay them out of your checking account and pay yourself back to the HSA, getting the tax advantage. If you use the insurance company's partners, a lot of times what they'll do is electronically give you the option to go online, see that claim, and click Pay Doctor and have the funds transferred directly from your HSA to the doctor. So the truth is it's not confusing. It's very easy. There's a lot of different ways to do it. It can be as simple as having a debit card or a checkbook. It could be transferring funds after the doctor's visit happens online. It could be set up that it can automatically pull as well. There's some that can set it up that way. So there's a lot of different ways to go about it. These are things that we would discuss with the employer ahead of time, depending on which company they use to administer the health savings account, would tell us what options are available, and then we would talk through to see which ones made the most sense for those employees.
The The next question, what are the costs related to administering a health savings account plan?
So when you work with an insurance company's partner, a lot of times the insurance company will absorb those costs. When you work with a third party, you might be looking at a couple dollar per month employee charge to administer it that comes out of the employee's funds. And there may be a setup fee from a company to get something like that set up when you're working with a third party. So depending on what avenue you go with the insurance company's partner, typically they'll eliminate and waive all those fees. If you go with your own third party, you might have some additional fees. And while we're on this topic real quick, I'll just intervene here to say that there are reasons why a company would choose to use a third party and pay those fees. A lot of times those fees are very minimal to use a third party, but there can be times where it can make sense for a company, especially a company that's had to move their health insurance from one insurance company to another. The flexibility of having, or the ability to have their health savings account with a third party and not tied to one can eliminate a lot of headaches.
The next question, is the summary of coverage issued by UPMC compliant with the summary plan description requirement?
The answer is no. If the Department of Labor sent you a letter asking for the summary plan description and you provided them just the certificate of coverage, that is a part of the summary plan description, but that is not the whole thing, and that would not fully satisfy compliance in an audit with the Department of Labor.
Do we have any more questions?
If any more come in, we will answer those and we will send those out. I do want to direct everybody to check out our website, www.jrgadvisors.net. Oh, and I'm getting a wave. I think we have one more question coming in. Let's take that, please.
Does the insurance carrier not cover the subscriber's responsibility until the annual HSA election is exhausted, or does it kick in once you have met the deductibles and out-of-pocket costs?
So I think what the question is asking is when does the insurance company pay, and how does that HSA work? And let me use an example. This is not specific to one company, but an HSA has to have a minimum deductible. So let's say an HSA qualified plan has a deductible of $1,500. That plan for a single person, the $1,500 would have to be met before the insurance would kick in. And the plan design would then determine if that plan is 100% coverage after the deductible has been satisfied, or 90 or 80% coverage with some additional co-insurance, additional out-of-pocket from the employee. That's something that would be determined in advance. But once the deductible and out-of-pocket maximum have been satisfied, then the insurance company does pay 100% of all costs. You will see some plans that will have co-pays after the deductible for things like prescriptions only. Once the out-of-pocket maximum is hit on an Affordable Care Act compliant plan, even those co-pays go away, and then everything's covered 100%. And I hope I answered that the way it was being asked. If not, tell me and we'll make sure we get the correct answer out to you. Fantastic. It looks to be all the questions we have today. Again, check us out at jrgadvisors.net. Please join us for our next WebEd webinar. That's going to be October 14th at 10 a.m. and that's going to be on Medicare open enrollment. So businesses out there, if you have employees that are getting close to Medicare age, something that you'll want to tune into and learn about, as well as for anybody who knows anybody who's getting close to that age. So we'll look forward to talking to you then. Thank you so much.